our depreciation based on a change of our useful life and residual value. In this example, it tells us that equipment with a cost of $180,000 has an estimated residual value of $14,400 and an estimated useful life of 16 years. And it has been depreciated using the straight line method. In Part A, we need to determine the amount of annual depreciation. In Part B, we have to determine the book value at the end of the 10th year of use. And finally, in Part C, we're going to assume that at the start of the 11th year, our remaining useful life is now 8 years, and the residual value is estimated to be $10,500 for the remaining 8 years. So, in Part A, it asks us to determine the depreciation that would have been recognized every year based on the initial information given. So, under the straight line method, we calculate depreciation by taking our initial cost, subtracting away the residual value, and dividing it by its useful life in years. So for our problem here, our initial cost was $180,000. We are going to subtract away our residual value of $14,400, and then we are going to divide by its useful life, which was estimated to be 16 years. So again, we will calculate our $180,000, which is our initial cost, minus our residual value of $14,400, and we will divide that amongst the 16 years that we plan to have the asset, which gives us our annual depreciation amount of $10,350. So that is our answer for Part A. Based on the initial estimates we had, we were recognizing $10,350 in depreciation expense every year. In Part B, it asks us to determine the book value at the end of the 10th year of use. Remember, book value is calculated by taking our initial cost and subtracting away all of the accumulated depreciation for that asset. Accumulated depreciation is a contra asset account and therefore is a permanent account, meaning that the balance does not get closed at the end of the year. So we'll take our initial cost of the $180,000 and we're going to subtract away our accumulated depreciation. We recognize $10,350 in depreciation expense each year as we calculated in Part A, and we've been doing that for the past 10 years. The $10,350 multiplied by the 10 years will get us our accumulated depreciation value. So again, we take the $180,000 in initial cost, and we're going to subtract away the $10,350 times 10 to get our accumulated depreciation. So at the end of 10 years, the book value of our asset is $76,500. In Part C, they tell us that our estimates have changed as of the start of the 11th year of use. They tell us that from this point forward, we believe that there'll be 8 more years useful on this asset, and therefore our residual value would drop to $10,500. They now want us to calculate our new depreciation expense per year for the next 8 years. When we're revising our depreciation, the revised amount is only used going forward. We do not go back and adjust the prior years. So when we're revising our depreciation, we're going to use, again, straight line, but instead of starting with our initial cost, we're going to start with our book value. We can't start with our initial cost because we've already depreciated this asset for the past 10 years. We're going to subtract away the new residual value, and we're going to divide it over its new or remaining useful life. So we would take our book value of $76,500. We will subtract away our new residual value of $10,500, and we're going to divide it over its remaining useful life that we estimate to be 8 years. So we would take our $76,500 book value minus our $10,500 new residual value, and we're going to divide it over the 8 years that are remaining on the asset's useful life. That gets for us our new annual amount of depreciation expense that we'll recognize each year for the next 8 years, and equals $8,250.